Hello there, YouTube. Welcome to Mom and Pop Know Best. Today's video, we're going to be talking about refinancing and interest rates. So I've been talking to some of my friends, and we were talking about how the interest rates have just been slashed by the feds. And is now a good time to refinance a home? Is it a good time to buy a new home? Is it a good time in general to do any borrowing, given how low interest rates are? And are they going to get lower? Are they going to go up? Are they going to continue to stay the same? What's happening with interest rates? So I wanted to discuss a little bit about how to consider and how to compute the benefits of refinancing versus just paying extra a month in order to pay down the principal. So I put a couple of examples together here, and then and later on in the video I'm going to show Dave Ramsey's Payoff Calc and how to use that and how to interpret what is coming out of it, as well as interest rates and what interest rates are today. So with that being said, let's take an example of a $300,000 home. Let's say we put $50,000 as a down payment, and we have a loan amount of $250,000. In scenario one, here we are assuming 30-year mortgage fixed at 4% interest rate. The monthly payment amount is $1,194. The other example is 15-year mortgage at 3% fixed. And again, the same thing, $300,000 home with $250,000 loan. In this case, the monthly payment is $1,726. The difference is $533 extra per month for the 15-year mortgage. And of course, that is to pay off the loan faster. So I also broke out the amortization table for the 30-year mortgage, which is right here. As you can see, 360 payments. The principal at the end is $250,000. Interest is $179,673. Here we are assuming we're not paying anything extra per month. So you amortize the loan over 360 months or 360 payments. Now, the second example, which I'm going to flip over, which is here, this is the 15-year mortgage. And as you can see, it is 180. And what I've done is I've also computed its total interest, principal, and again, no extra principal here. Now I have an example in the middle that I'll go over quickly, and then we will unpack every one of these separately. So this one is assuming the 30-year mortgage, but we are paying 533 extra principal per month. So what does that get us? That gets us to how many payments? We would have a total of 199 payments opposed to 360 payments. And then that would also mean a reduction in interest by about $87,000 or $88,000 rather. So this is the more traditional option, which is to just go in and take a 30-year mortgage fixed at 4%, and you pay $1,194. Again, I kept taxes and insurance out, or any HOA fees, just because those are equal in both cases. So we wanted kind of to compare apples to apples. So I left those out. So your payment amount just for principal and interest will be $1,194, and you would continue to pay that over 30 years. So as you can see, you start off by paying a tremendous amount of interest compared to the principal you're paying. So we just recently bought a home, and we started off with a 30-year mortgage, and unfortunately we couldn't put the full 20% down, so we had to pay private mortgage insurance, which was also another $100 or $150 a month, which was just an outrageous thing. So that drove me crazy. So after a year, we figured, let's go ahead and refinance. So just looking at this, $833 in the first month goes purely to interest. Yes, it is a write-off, but after tax reform, it's no longer as substantive as it was before tax reform, because now your kind of your standard deduction is already high enough that many people will not be able to claim their mortgage interest as a deduction. But having said that, this is how much you are paying per month in interest, and as you can see, it keeps on getting lower and lower and lower every month, and your principal gets higher and higher and higher. So essentially, in the first year, so let's kind of go to 12 months. In the first year, you paid $9,900 in interest compared to only $4,400 in principal. And every year so on, again, those numbers kind of they kind of equate, and then at some point the principal becomes higher than the interest. But as you can see, it is such a daunting thing given how long it takes for you to finally pay down the loan. Now, the other example here, this is, let's say I didn't want to refinance and pay the extra $3, $4, $5,000 in closing fees. So what I end up doing is saying, okay, I'm going to take the $533 and I'm going to just throw that towards principal every single month. And here I'm just assuming that it's done at month one of payment. So this way, again, it is apples to apples. So as you can see now, my total principal is $893 rather than just the $360. And my interest is still $833. But you can see now the interest will start to decrease at a faster rate just because I'm paying down the principal of which the interest is actually assessed on. So in this case, and that's why you see that it will only take 199 months rather than 360 months to pay down the mortgage. And the difference here, I actually computed the difference here. This is interest. This is actually comparing it to the 15-year. So the 15-year, what it's doing is now right off the bat, your interest is $625 compared to the $833, and your principal is $1,100. So in the first year, you're actually paying $7,300 in interest compared to $13,400 in principal. Now we compare that to the case where we just kept the 30-year mortgage and we decided to pay extra. So your principal here is actually $10,917 compared to interest of $9,800. So again, you're still paying extra interest, but the 30-year where you're paying extra per month gives you the option or the flexibility to say, you know what, this was actually a tough month and I don't want to pay extra and I want to keep the $533 in my pocket, or I want to spend it elsewhere, or I want to invest it elsewhere. Those are, again, I've seen folks and schools of thought that say, I want to take the 30-year and I want to invest the difference into stocks and bonds. But as we saw, the stock is crashing now. So again, be kind of careful there. So then just here, this is the comparison of interest, which is, again, the cost of borrowing money from the 15-year compared to the 30-year without paying anything extra. So you can see over the life of the 15-year mortgage, you're actually saving about $65,000. If you do pay extra per month, you are saving $30,000. And this one is just comparing the interest here compared to the interest over here in this example where we are paying the extra principal. And finally, if I go back here, I'm paying interest of $179,673 if I do not pay anything extra, and this is the 30-year mortgage. If I do pay the $533 extra a month while keeping it at 30-year mortgage, I end up paying $91,935 in interest, which is savings of $87,738. And then if I do decide to go with the 15-year mortgage, I actually end up paying $60,000, which is $31,173 in savings on top of the 30-year where I was paying extra. And if I want to compare it to just purely the 30-year where I wasn't paying anything extra, I'm actually saving about $119,000 in interest over the span of 15 years. And the idea here is, yes, inflation should be factored in for sure. But if it is your primary home, and this is, again, this is not financial advice in any way. This is just how I personally thought through it. If I have a primary home, I want to pay off the mortgage as fast as possible. And this way I would have sufficient equity if I want to sell the home, or I want to take a home equity line of credit, a HELOC. This way I do have, it serves as money, as money in the bank on top of the appreciation in my home's value. Versus at 30-year, it is just a completely daunting thing, and it has such a psychological effect that you feel like you're going nowhere. You keep on paying rent over and over and over again. So it is really, really a long process for the 30-year. And that's why I thought about it and I said, you know what, I'm gonna jump ship and I'm gonna go to a 15-year. But luckily, I did that only a year into my 30-year mortgage, and I did that, and I was able to take advantage of some appreciation in my home to cut down the private mortgage insurance from 120, $130 to only 20 some dollars, which is again a significant difference. And now I'm able to actually remove that rather quickly because now I'm paying much higher principal every month. Again, it does mean that you have less money in your pocket on a monthly basis, but you think of it as it is a savings account that you're sort of just pushing money to, and you're not really kind of keeping it in your pocket, because again, money that sometimes you keep in your pocket, it burns a hole in your pocket. So with that said, I wanted to switch gears quickly to look at today's mortgage rates. All right, here are today's mortgage interest rates. So for a 30-year fixed, we're looking for 4.125. For a 15-year fixed, we are looking at a 3.25%. And there is the interest rate, and then there is the APR. The APR really includes a bunch of fees in it, as well as the cost of the loan on top of the interest rate. That is why typically it is a little bit higher. So there you go. Then if we look at Wells Fargo, you see that the refinance rates for a 30-year fixed is 4.25. For a 15-year is 3.25. Purchase rates are a little bit smaller. So a 30-year fixed rate is 3.750, and for a 15-year it is at 3%. Now, finally, the last website I want to show you is Dave Ramsey. Shout out. This is Dave Ramsey's mortgage payoff calc. So here you can put the original loan amount, so the $250,000. First payment, January 1st, 2020. Let's say it's 30-year, and let's put the 4.0 that we had. That's where we got the 1193.54. Hit continue. This is where you could say, all right, I want to put $533 extra in principal monthly. Calculate results, show me how fast that will help me pay off my mortgage. This is where these numbers are. Again, so you can go and play with this and figure out, okay, what actually makes sense and what doesn't, and really to try and make an informed decision. Now back to our spreadsheet. So here we can see that, okay, if I am comparing a 15-year to a straight out 30-year mortgage, in the first couple of years, how much am I paying in additional interest? So I'm paying about $5,400 in additional income just in the first couple of years of owning the home, or of having a 30-year mortgage. Now let's compare that to the option. So this is the 15-year option compared to the 30-year option, where I'm paying $533 extra a month. So here the difference is about $4,900. So this kind of will help you gauge how much does my closing costs need to be for me to say, okay, this is actually worth it for me to refinance, or no, it's really not worth it. The other idea is, again, with a 30-year mortgage, you are more flexible, that 1 month you can pay extra, 1 month you don't have to. If you get a bonus, let's say it's a quarterly bonus or an annual bonus, you can throw a chunk of change on to at your principal instead of having a monthly commitment. So those are kind of the ideas to keep in mind, and weigh your options and see how things are. So with that said, thank you so much, YouTube. If you like this video, please go ahead and hit the like button as well as the subscribe button. We will continue to bring you interesting content that is revolving around personal finance, as well as maybe if there's interest there on some Excel tips and tricks and how to do certain things in Excel. So you go ahead and comment on what would be most helpful to you and what you want us to make a video about, whether it's Excel, whether it's anything related to personal finance, or if you would like additional vacuum and white noises to put your little ones to sleep. Thank you so much and good night.